Hello friends, if you are in or near retirement and planning any large purchase, this video is for you. A moment finds almost every retiree who funds a large purchase with a lump sum from a traditional retirement account. It shows up on a tax return months later when the bill is thousands of dollars higher than expected, not because of the purchase itself, but because of where the money came from, a distinction the tax code makes in ways that are completely invisible at the point of sale. A second moment finds those same retirees a year or two later when a Medicare Part B premium statement arrives with a number nobody warned them about. The retirement account withdrawal from 2 years ago quietly raised this year's Medicare premium through a 2-year look-back rule, meaning by the time the surcharge lands on a statement, the purchase that caused it is long done and cannot be changed. And there is a third moment, the subtlest, when a retiree finds more of their Social Security income is taxable than it was the year before, not because the benefit changed, but because one large withdrawal crossed a threshold and pulled more of it into the taxable zone through a completely separate government system that operates on its own calendar, entirely disconnected from the moment the purchase was made. 3 bills, 3 government systems, 1 purchase, and today we walk through 5 specific purchase types that create exactly this pattern, so you can see the full picture before any money moves and any decision is made. Quick context first. This video is made for United States retirees and pre-retirees over 62 who want to understand the tax consequences of large financial decisions before committing. Everything here comes from official public sources. IRS Publication 523 on home sale tax rules, the IRS guidance on retirement account distributions, the Social Security Administration's benefit taxation rules, and the official Medicare website's information on the income-related premium surcharge. I will name each source as we go. This is educational content only, not personalized financial, tax, or legal advice, and nothing here is a promise of any specific payment or outcome. So before any large decision, speak with a licensed professional who knows your specific accounts. On this channel, the goal is to lay out the retirement rules that are hard to find in plain English, using what official sources actually say. Subscribe right now if that is useful to you, and share this with anyone weighing a large purchase in retirement. One question before the countdown. Have you ever made a large withdrawal from a retirement account to pay for something, a car, a trip, a renovation, without knowing it might affect your Social Security or Medicare? Type yes or no in the comments. Because the number of people who were never warned is a significant part of why this channel exists and why we are starting the countdown right now. Number 5 is the recreational vehicle, the boat, the second vehicle, the retirement reward, and the regret is almost never about the dream, but almost always about how it gets paid for. These are large purchases, and the most common funding method is a lump sum from a traditional retirement account, with the full picture of what that triggers coming in number 2. There is a second detail specific to these items. Unlike a home, recreational vehicles lose value from the moment you buy them, often quickly. Per the IRS, losses on personally used property, an RV, a boat, a personal vehicle, are not deductible, meaning you pay tax on the income used to buy it and receive no tax relief when it loses value, which is why the true cost of these purchases consistently runs higher than the sticker price. Number 3 is the second home, the vacation cabin, the condo in a warmer state. The trap catches people because they know about a home sale tax break, but apply it to the wrong property. Per IRS Publication 523, when you sell your primary home, you can exclude up to $250,000 of capital gain if single, or up to $500,000 if married and filing jointly, one of the most valuable breaks in the entire tax code. A second home does not qualify, and the entire gain is taxable when you sell it for more than you paid. Pause and write down the 2 of 5-year test. Per IRS Publication 523, to keep the primary residence exclusion, you must have lived in your home as your primary residence for at least 2 of the last 5 years before the sale. And that clock is worth hundreds of thousands of dollars to anyone who owns a long-held and highly appreciated home. Number 1 involves a tax break worth more, sometimes hundreds of thousands of dollars more, than any other item on this list. A retiree is ready to move, and someone suggests renting the long-held family home instead of selling. What that advice leaves out, the moment you move out and rent, a clock starts ticking. Per IRS Publication 523, The primary residence exclusion requires living in the home as your primary residence for at least 2 of the last 5 years before the sale. Year 1 after moving out. 4 of the last 5 years you still qualify. Year 2, 3 of 5, fine. Year 3, 2 of 5, right at the edge. Cross into year 4, and you have lived there just 1 of the last 5 years, meaning the exclusion is gone, and 3 years is all it takes for that break to vanish. And layered on top is depreciation recapture. Every year you rent, the IRS expects depreciation to be claimed, and when you sell, that accumulated depreciation is taxed back at up to 25% per the IRS, whether or not you claimed it, converting a completely tax-free gain into a fully taxable event with a second recapture layer on top. Number 4 is the annuity, sold as a safety purchase that punishes retirees for changing their minds. Most annuities lock money in for a surrender period, typically 6 to 8 years, and withdrawing early triggers a surrender charge that often starts at 7% and steps down each year. On a $50,000 withdrawal in the early years, that can be $3,000 or $4,000 going to the insurance company. When money comes out of an annuity, the earnings are taxed as ordinary income, not at the capital gains rate, per the IRS, and if funded with traditional account money, the entire withdrawal can be taxable income in the year it is taken. Write these 2 words down. Surrender period. Before signing any annuity, ask how long that period lasts and what the surrender charge is in each year, because that information is yours to have before you sign and not something to discover only after the money is committed. Before we reach number 2, here is an illustrative composite, not a specific individual. Take a couple we will call Barbara and Tom, early 70s Midwest. Barbara retired from teaching and Tom from manufacturing. Together they had about $320,000 in a traditional retirement account and decided to buy a motorhome, $90,000, to travel in retirement. They pulled the full amount in 1 calendar year. That withdrawal stacked on top of their Social Security and pension pushed their combined income past the threshold where up to 85% of their Social Security became taxable per the Social Security Administration, and triggered the Medicare income-related premium surcharge per the official Medicare website. Their Part B premiums rose the following year. The income tax came in at a higher bracket because the withdrawal filled the top of the income stack, and all of that extra cost arrived later through 3 separate systems without a word from anyone at the dealership. Number 2 is about a specific way of paying for any purchase. Per the IRS guidance on retirement account distributions, every dollar from a traditional account is ordinary taxable income, not at the capital gains rate, and one withdrawal can produce 3 separate bills at once. First, bracket creep. It stacks on every other income you have, and the last dollars of a large withdrawal are the most heavily taxed you pay all year, which is why the same amount spread over 2 or 3 calmer years costs less. Second, per the Social Security Administration, once combined income crosses $34,000 for a single filer or $44,000 for a married couple, up to 85% of Social Security benefits can become taxable. So pause and write those thresholds. $34,000, single filer. $44,000, married couple, per the Social Security Administration. Third, per the official Medicare website, Medicare Part B premiums are based on income from 2 years prior, and when that look-back year crosses the applicable threshold, the surcharge known as IRMAA, per the Centers for Medicare and Medicaid Services, locks in a higher premium for a full calendar year, meaning a large withdrawal this year raises your Medicare premium 2 years from now, and the retiree who paid all 3 was simply missing the knowledge that would have changed the outcome. Here is the thread connecting all 5. 4 of the 5 regrets are not about what was bought, but about the dollars used to buy it. Roth withdrawals and already taxed savings do not affect IRMAA, while traditional account withdrawals do every time. The habits that prevent these regrets. Trace the money source before any large purchase and ask what it triggers. Never let one purchase create one enormous taxable year by spreading traditional withdrawals across calendar years. Know the exit tax on any asset before you buy it, because a second home, an annuity, and a converted rental each carry a tax structure on the way out. And protect the breaks you already have, especially the primary residence exclusion, before trading them away for something that may cost far more than it ever earns. 5 through 1. Number 5. The recreational purchase, taxed on the income used to buy it, Worth less on the way out, no deduction for the loss. Number 4, the annuity surrender charges if you exit early earnings as ordinary income per the IRS. Number 3, the second home full capital gain, taxable no primary residence exclusion per IRS publication 523. Number 2, any large purchase funded by a traditional withdrawal bracket creep, more Social Security taxable per the Social Security Administration, and the IRMA surcharge 2 years later per the Centers for Medicare and Medicaid Services. Number 1, the family home converted to a rental, the 2 of 5-year clock gone by year 4 per IRS publication 523, plus depreciation recapture at up to 25% per the IRS. 3 things to do right now. 3. If you own a long-held appreciated home and are thinking about renting it before selling, check your calendar and know where you stand on the 2 of 5-year test before you sign a single lease. 2. If you are planning any large purchase involving a traditional retirement account, check the Social Security Administration's combined income thresholds and the official Medicare website's IRMA information against your own numbers before you commit. 1. Before any large purchase or withdrawal, talk to a licensed CPA or financial advisor to see the full cost, the tax, the Social Security effect, and the Medicare effect before the money is gone. Then share this with one person about to make one of these purchases without knowing the real cost waiting on the other side. Coming up next, the Roth conversion window most retirees miss before required distributions begin, the quietest low-tax opportunity most people never use. And before you go, at 10 minutes in this video, there is a line that separates 2 retirees who funded the exact same purchase, and one of them paid thousands more, with the only difference being where the money came from before the purchase was made.